Chapter 17 in Business Finance. In Chapter 17, we continue our discussion from Chapter 16 about short-term financial management of an organization. We're going to look at the different components, starting with cash management. So why would a company want to hold cash? Well, this particular theory that we see here was developed by John Maynard Keynes. And he said that there are three reasons that companies want to hold cash. One being for speculative reasons, is so they can take advantage of unexpected opportunities. One is because of a precautionary motive, in case of emergencies, in case something happens, just in case we need it. And one is the transaction motive, or to pay our day-to-day bills or manage our day-to-day operations. So when we look at how much cash we want to hold, what we want to look at is that trade-off between the opportunity cost of holding cash versus the transaction cost of converting marketable securities to cash. So first we're going to talk about float. So what is float? Float is the difference between cash balance recorded in the cash account and the cash balance recorded at the bank. So if you remember back to your accounting classes where we did bank requisitions, we talked about this, so how we have to reconcile the difference between our accounting cash account and the cash balance recorded at the bank. So now when we're talking about it in finance, we're calling that difference float. So we have one that is disbursement float, which is generated when a firm writes checks or sends payment out. So then the available balance at the bank minus the book balance is greater than zero. Or we have collection float. This is when we receive money from people that increase the book balance before these things have been deposited at the bank. So therefore, the available at the balance at the bank is smaller than our book balance. And our net float is the disbursement float plus the collection float and how many days that is. When we had to do all money transfers either via mail or in person, float was a much longer thing, and the management of float was a much bigger deal. As we get into more electronic transfers of funds, we see less and less times of float, and it's not as much of a manageable situation. So float is a management concern. We want to make sure that we maintain our collection and disbursement float so that our account never drops below zero. So we're never negative or in the red. So different ways to speed up collections or slow disbursements. We can look at mailing time. We have processing delays, availability delays, different things that you can do. So one of the examples in the textbooks for mailing time is that we would mail from a location that would take longer to arrive in the post office to give us a couple of extra days time. Or we would delay processing the transaction in order to increase our float. We also have what was called check kiting. Check kiting is a systematic overdraft. It's a method of writing checks for no economic reason other than to exploit float. This was also an issue with ATMs. Previously, you don't have this problem with ATMs anymore, but these used to be a type of fraud that could be completed with ATMs by saying that you deposited a check by putting in empty envelopes into an ATM or depositing in a check into an ATM and then taking the cash out before that check had cleared, not knowing whether or not that check was going to clear. With the two things, electronic data interchange, which is our electronic transfer of information, and a law in 2004 called Check 21, where the bank can receive an image of a check, we have really eliminated a lot of the float issues and any types of fraud that were used by exploiting float. So before Check 21 was put into law, banks had to physically receive a copy of a check before they would record a payment. And so if you mailed it to pay off your credit card, they wouldn't record that against your credit card payment for the credit card company until the credit card company took it physically to the bank. Now, with electronic images and electronic transfers, we've eliminated a lot of the time issues with float. But we're going to look at a couple of examples of float because it still does exist. There still are, even with electronic transfers, and we still do a lot of payments with paper checks and other things, just not as much as before. So we have $3,000 in our checking account. We deposited $2,000 and wrote a check for $2,500. So what is our disbursement float? What is our collection float? What is the net float? Our book balance and our available balance. So we have the collection day is the difference between when the payment is mailed and the cash is available. We have mailing time, processing delays, and then availability delays. So the float management goal is to reduce collection delay. So first you have to receive it in the mail, and then you have to process it. And then there might be an availability delay. I don't know if any of you have ever had that before when you deposit a check, a large check, and they say, you know, $100 of this will be available immediately, and you have to wait 3 business days for the rest of it to clear. That's an example of an availability delay. That is still fairly common at banks. I know my bank still does that. If I deposit a check, they keep a portion of it back for several business days. So when we're collecting cash from customers, we have multiple ways that we can do that. We can do over-counter collection. This is point of sale collection. So you go into a store, you walk up to the cash register, you hand them money. That's over-the-counter collection. You can do pre-authorized payments. That is where the payment amount and dates are fixed in advance, and your payments are automatically transferred. You might do this with your rent, where you electronically pay your rent and you sign forms that it comes out on the 1st of every month. Or you can pay via mailed checks. So you generally have one mailing address that those checks can go to, or there are various collection points. If there are various collection points, it's likely that you mail that check to a P.O. box, and that they have different P.O. boxes for different geographical regions. These type of P.O. boxes are called lock boxes. So the local bank, if I have a business that is in Iowa, but it's a national business, and people can mail me money from anywhere, I might have a bank that has regional locations, and instead of them having to mail everything to Iowa, I have them mail it to a regional location. For one thing, that reduces a mailing delay. It might take 4 days to get to me from New York, but it's only going to take 2 days to get to New Jersey. So they use geographical locations. The bank picks up the checks and deposits them into the firm's account. Cash concentration is a procedure to gather funds into our firm's main accounts. So for example, if I have a lockbox and I have 4 or 5 geographically located all around the United States. Then I need to find a way to gather the funds from those different regional banks into my main account. But these lockboxes and cash concentration methods help to reduce any mailing and processing time that we might have. Think about if you pay your utility bill by check. So if I'm paying a utility bill by check, first I receive the utility bill in the mail. And then I write a check and put it in the mail and mail it back to the utility company. They receive it, they record it in their accounting records, and then they create a bank deposit to submit it to the bank. And so if I just sent it to the bank directly and they deposit it in the utility account, that would remove several days worth of mailing and processing steps. This is an overview of how that lockbox system works, that customers mail their payments to various post office boxes in a geographic region. The bank collects those funds, separates out the checks and receipts, and deposits them in the bank accounts. The receivables go to the firm, and the firm processes that. And if we add the lockboxes with a concentration, then the local bank deposits send them to a concentration bank, and a cash manager keeps track of that information and then disperses it out. So we had cash collections, customers sending us money, and we want those to come as fast as possible. However, when we pay money out, we want to delay that. So disbursement float is desirable for us. Slowing down payments increases our disbursement floats. So we mail checks from a distant bank or post office. That may not be ethical or optimal. We don't want to anger our suppliers or people that we're paying accounts payable to. We want things to be received on time. Different ways that we can control disbursements are with zero balance accounts and controlled disbursements accounts. So zero balance accounts are where the firm maintains a master bank account and several sub-accounts. The bank transfers funds from the main accounts to the sub-account as things are presented for payment. So here's an example of that. So we have a payroll account and a supplier account. We really don't keep very much money in there. We just keep a little bit of safety cash in there, a couple $100. And then when our payroll is processed, we find out what the amount of the payroll is, either internally or from our payroll company, and then the bank transfers the amount of the payroll 2 days before the payroll processes. Same things with the suppliers. That's a zero balance account. Of course, we know that we want cash to work for us. We want to invest any of our idle cash so that it is earning interest instead of just sitting around. The opportunity cost of cash, holding cash, is not earning interest. So we can use a money market account. Money markets are financial instruments with maturities of less than 1 year. There are multiple different kinds of financial instruments that can be purchased in a money market situation. We might maintain temporary cash surpluses for a variety of reasons. One of those would be if we have seasonal activities that we need extra cash for at different times, or if we have planned upcoming expenditures. We could buy marketable securities with seasonal surpluses and then convert them back to cash when we need them. So when we're off season and we have extra cash, we want to invest that, and then right before we come into our season, we want to sell them so we have the cash surplus. If we have a planned expenditure coming up, such as a dividend payment or something, we might accumulate those securities in anticipation of that upcoming disbursement. So here we have where we're using short-term financing to fill in our seasonal cash demands. We're going to use both marketable securities and a combination of bank loans. So anytime that we have a cash surplus, we're going to invest, and then when we have a cash deficit, we're going to sell those marketable securities and borrow from the bank to fill in that cash demand.